Let us now try to solve this comprehensive example and find out what are the cash flows. Now, as we have discussed earlier, cash flows will not require any inputs other than the income statement and the balance sheet. So if you have these two, you should be able to come up with your cash flow statements. So we have been given 2 years of balance sheets, that is 2007 and 2006, and we also have the income statement for 2007. Now what we must try and do is find out CFO, CFI, which is cash flow from investments, and CFF, and we will also find out cash flow from operations using two methods, the direct method and the indirect method. So this will reconcile all our learnings till now on the cash flow statements. So let's try and start with the direct method to find out the cash flow from operations. So let us find out what are cash flow from operations using direct method. In direct method, we start with the cash receipts. Now cash receipts we have seen earlier. This is basically sales which we take directly from the income statement, plus we look at an account called accounts receivables. Now it depends whether the account receivables have increased or decreased, so the cash impact will be looked at from the balance sheet item called accounts receivables. So let's try and find this out. What are the sales numbers here? The sales numbers are nothing but 200,000, and let's look at the accounts receivable section in the balance sheet. It has jumped from 18,000 to 20,000. So account receivables have moved up by 2,000. So this implies that our current asset has gone up by 2,000. So if current assets move up by 2,000, what we can assume is that in order to build up this asset, we must have spent cash. So cash goes down. So essentially this transaction would have led to a decrease of cash by 2,000. So this is the number that we kind of show here in the accounts receivable. So let me put that number. This would be 200,000, and account receivables cash impact is basically 2,000 as a cash outgo. So what we have in terms of cash receipt is 198,000. Now the second thing that we must look at is beyond cash receipt. The second item that comes in the income statement is COGS. So we'll call this as cash expense related to COGS. Now cash expense related to COGS, we have seen earlier, we look at the income statement COGS first, plus there are two accounts in the balance sheet that affect the COGS. One is the inventory account and the second one is the accounts payable account. So we look at the cash impact because of these two balance sheet accounts. So let's look at these as such, and we go back to our balance sheet and the income statement. So let's kind of identify those. Here we have COGS that is around 80,000. Now the two corresponding entries in the balance sheet with respect to COGS are inventory and the accounts payable on the liabilities side. Now this is the asset. Now if you look at 2006, inventory was 14,000 and inventory has decreased to 10,000. So inventory has actually gone down by 4,000. So we have looked at this condition earlier. If assets go down, cash comes in. So this transaction will be treated as a positive cash flow. Likewise, let's look at accounts payable. This is current liabilities, and what we note here is that current liabilities have increased from 18,000 to 18,000. So there's an increase of 8,000 during the year. If current liabilities increase, we know that cash would have come into the system. So this also has a positive cash impact. Inventory also has a positive cash impact. So let's just go back and look at our formula. COGS, we have this as 80,000, and since this is expense, it comes with a negative sign, and inventory related cash impact is positive 4,000 and accounts payable related impact is positive 8,000. So this is what we'll write here. So the total cash expense because of COGS will come out to be minus 68,000. Now the third thing, let's go back and look at our income statement. Direct method involves looking at your income statement. So the third expense we may have to look at is the wages. So wages here are how many? 10,000, and the corresponding balance sheet item that we may look at would be the wages payable. So here it is wages payable and here it is wages expense. So let me write this down in the form of a formula. It would be cash expense because of wages. This would again be wages expense in the income statement plus your balance sheet impact where we have the wages payable. So the impact because of wages on the income statement, let us try and understand that. So here we have cash or expense which is 10,000 in the income statement, and let us look at wages payable in the balance sheet. Wages payable was 16,000 and it is now 9,000. So what has happened is this current liability, which is wages payable, has decreased to by 7,000 during this year. So you have essentially repaid your liabilities. You paid down your liabilities. That means this is a cash outflow. So cash outflow. So this essentially leads to negative cash impact. So your cash expense was 10,000 here with respect to the wages in the income statement, and from the wages payable from the balance sheet this is another 7,000. So this comes out to be minus 17,000 here. Okay, so this is about the wages payable. Let's look at the other line items in the income statement. It would be important. We don't consider depreciation expense because it is not a cash expense, it's a non-cash expense. It's not required. Let's look at the interest expense. So interest expense is written here in the income statement. Let us see if we have any item within the balance sheet which is related to interest expense. Here we have one. This is interest payable. So look at this. Interest payable has increased from 6,000 to 7,000. Now let me first write down the formula. Cash expense with respect to interest. So again we'll write the same interest which is mentioned on the income statement plus your balance sheet interest payable. So here we have seen that interest payable is a different number. Here interest expense was minus 1,000, and let us look at the balance sheet now. Balance sheet, here we see that the current liability which is related to the interest payable has increased by 1,000. So this would mean that cash has come into the system. 6,000 to 7,000 there is an increase in liability. An increase in liability is treated as a cash inflow. So corresponding to this balance sheet interest payable, the cash impact would be plus 1,000, that is cash inflow. So cash expense related to interest is 0 here.